Welcome to Chapter 10, Module 2. We're going to continue the discussion of standard costs and variances around labor and manufacturing overhead. All ready, Sketch?
You bet! Let's do this!
First up, let's compute the direct labor rate and efficiency variances and then explain their significance. Let's work through this problem. Glacier Peak Outfitters has the following direct labor standard for its mountain parka: 1.2 standard hours per parka at $10 per hour. Last month, employees actually worked 2,500 hours at a total labor cost of $26,250 in order to make 2,000 parkas. Sketch, what's our actual production level?
That's easy. 2,000 parkas.
And what's the amount of standard labor needed to make a parka? And the cost of that labor?
That would be the standard. 1.2 hours per parka at $10 per hour.
And what was the actual labor incurred and the cost of that labor?
I'm thinking that would be 2,500 hours at a total cost of $26,250.
Okay, now let's build our table. The first thing we do is set up our table. Actual hours times actual rate, actual hours times standard rate, and standard hours times standard rate.
The standard hours of 1.2 hours per parka times the 2,000 parkas produced gives us 2,400 labor hours that we expect to be used to make the parkas. Then times the standard cost of $10 gives us $24,000.
The actual hours consumed to make 2,000 parkas was 2,500. Times the standard rate of $10 per hour gives us 25,000. The difference between the 24,000 and the 25,000 is the labor efficiency variance, which is the difference between the actual quantity of labor hours and the quantity allowed according to the standard. It's $1,000 unfavorable. Unfavorable because the actual quantity of hours exceeds the standard quantity allowed by 100 hours.
Actual hours were 2,500. We don't know the actual rate, but we don't need it because we are given the total actual labor cost of $26,250.
Given the 2,500 actual hours and the $26,250 actual cost, for comparison purposes, we can see that our actual rate is $10.50 per hour. The difference between the 25,000 and the 26,250 is the rate variance, which is the difference between the actual average hourly wage paid and a standard hourly wage. It's $1,250 unfavorable. The rate variance is labeled unfavorable because the actual average wage rate was more than the standard wage rate by 50 cents per hour. As a reminder, for standard hours times standard rate, we took the 2,000 parkas that were produced and multiplied by the amount of hours that we should have used, or 1.2 hours, to give us the 2,400 hours. Instead of setting up the table, we could have solved that problem using equations. For the rate variance, we take the actual hours times the difference between the standard rate and the actual rate.
For labor efficiency, we take standard rate times the difference between standard hours and actual hours.
Labor variances are partially controllable by employees within the production department. For example, production managers or supervisors can influence the following:
the deployment of highly skilled workers and less skilled workers on tasks consistent with their skill levels.
the level of employee motivation within the department,
the quality of production supervision,
and the quality of the training that's provided to the employees. All of these things can have either a positive or negative impact on our variances. Next up, let's look at how to compute the variable manufacturing overhead rate and efficiency variances and explain their significance. Let's go back to our Glacier Outfitters Company and calculate our overhead variance. If Glacier Peak Outfitters has the following direct variable manufacturing overhead labor standard, 1.2 standard hours per parka at $4 per hour, and we have the following facts: employees actually worked 2,500 hours to make 2,000 parkas, and our actual variable manufacturing overhead for the month was $10,500. Sketch, what's our actual production quantity?
Same as before, 2,000 parkas.
What's the amount of standard overhead needed to make a parka, and the cost of that overhead?
That would be the standard, 1.2 hours per parka at $4 per hour.
And what was the actual overhead cost?
That would be the 2,500 hours at a total cost of $10,500.
Okay, now let's build our table. First step is to set up our table: actual hours times actual rate, actual hours times standard rate, and standard hours times standard rate.
The standard hours of 1.2 hours per parka times the 2,000 parkas produced gives us 2,400 labor hours that will be used to apply the variable overhead. Then times the standard cost of $4 gives us $9,600.
The actual hours consumed to make the 2,000 parkas was 2,500 times the standard rate of $4 per hour gives us $10,000.
The difference between the $9,600 and the $10,000 is the variable manufacturing overhead efficiency variance, which is the difference between the actual activity of a period and the standard activity allowed, multiplied by the variable part of the predetermined overhead rate, is $400 unfavorable. The efficiency variance is unfavorable because the actual quantity of the activity, hours, exceeds the standard quantity of the activity allowed by 100 hours.
Actual hours were 2,500. We don't know the actual rate, but we don't need it because we're given the total actual variable manufacturing overhead cost of $10,500. The difference between the $10,000 and the $10,500 is our rate variance, which is the difference between the actual variable overhead costs incurred during the period and the standard costs that should have been incurred based on the actual activity for the period. It's $500 unfavorable. The rate variance is unfavorable because the actual variable overhead rate was more than the standard variable overhead rate by 20 cents per hour. As a reminder, for standard hours times standard rate, we took the 2,000 parkas produced and multiplied by the amount of hours we should have used, or 1.2 hours, to give us 2,400 hours. If we wanted to back into an actual rate, we take the total actual cost and divide by the 2,500 hours. As before, instead of setting up the table, we could have solved this using the equations. For variable manufacturing overhead rate variance, we take the actual hours times the difference between the standard rate and the actual rate.
And for the efficiency variance, we take the standard rate times the difference between standard hours and actual hours.
I have one small clarification we need to make. Think about the hamburger meat that McDonald's orders for their sandwiches. They may have several orders purchased at different prices in the freezer at any one point in time. So when they go pull a box of meat out of the freezer to use, it would be really hard to determine which purchase that box came from because they all look alike. Purchasing happens at a different time than the actual use of the product. Because of this, when the quantity of materials purchased differs from the quantity used in production, the quantity variance is based on the quantity used in production, and the price variance is based on the quantity purchased.
I guess that means we can't use our 3-column table?
Well, we can. We just have to add a 4th column. Let's take a look at how this works. With Glacier, we have our standards of 0.1 kilogram of fiberfill per parka at a cost of $5 per kilogram. But this time we purchased 210 kilograms for $1,029, but only used 205 kilograms to make the 2,000 parkas.
So we would use the quantities purchased and their cost to calculate the price variance, and the quantities used and their cost to calculate the quantity variance.
To calculate the quantity variance, we calculate the standard quantity and standard price for the current production levels and compare it to actual quantity consumed and standard prices, again for current production levels.
So actual quantity is a quantity of raw materials used, since we are calculating the quantity variance.
That's right. Our quantity variance is $25 unfavorable. Then, for price variance, we compare actual quantity purchased, not used, times standard price with actual quantity purchased times actual price.
I got it. We use quantity purchased to calculate the material price variance.
That's right. In this case, our price variance is $21 favorable. Some advantages of standard costing are that it allows us to manage by exception or only focus on transactions that are outside of an acceptable tolerance range. Our variances help us determine which transactions to look at.
Standards can really simplify bookkeeping. We don't need to know actual costs every time a unit is sold. By using standards, we can record those transactions without figuring out exact costs each time.
We can use standards to enforce responsibility accounting by holding department managers responsible for the variances that they have from standards.
And standards can also give us benchmarks that show us the most efficient production levels.
Here are some things to watch out for. Standards are usually prepared monthly, so the information's already getting old when we get a chance to look at it. So it could be outdated in a rapidly changing environment.
Standards shouldn't be used as negative reinforcement. That could cause morale to drop.
And we also have to be careful when we treat labor as a variable cost. In a lot of companies, labor is more fixed than variable, since companies are reluctant to lay employees off or to cut back hours. Standards also encourage management to meet them, not necessarily exceed them, which may not be sufficient in a highly competitive environment.
And remember that just because a variance is favorable, it could cause a negative impact on the business, such as buying cheap raw materials that would cause a quality problem.
So we have to remember to use standards as just one tool in our toolbox of management information. If we focus too much on standards, it could negatively impact other areas that are just as important, such as quality or on-time delivery or even customer satisfaction. Well, that's all for Chapter 10, Module 2. See you soon.